Well, thanks, Dan. I think with that intro, what you're really saying, I'm no longer capable of talking about anything in detail at the technical level. And so that's why I was chosen to cover a topic at a little bit more of the higher level. But good afternoon, everyone, and let me thank Toby and Dan for the invitation to join you here today. I know that drinks do follow my speech. That's always tough, considering I like to talk over, as my team knows. So I will try to keep it brief. On a serious note though, we all come together here, as you have today, as investment professionals and advice professionals. Obviously the two fit hand in glove. And it's important therein that we share some ideas both about where we are, about navigating the future, and particularly, the way in which this conference allows each, I think, and every one of you to actually share those ideas and learn from each other. So I think it's great that this conference is on today. I see some pretty familiar faces in the room, but as Dan said, I'm Jeff Lloyd and I'm the CEO of Perpetual. I have the pleasure of being in that role now for coming on 6 years. And I'd have to say that at Perpetual, across the three divisions that we have, we're also facing this time of change, but this time of opportunity that I think that many of you are exploring the opportunities that do exist in the way that we deal with the future of advice and the future of asset management in this country today. And interestingly, tomorrow, we open the FSC conference, the Financial Services Council, and as chair of that, I'm going to give a little insight to some of the things I'll be saying today about trust particularly. Now, of course, Perpetual's 130 years old and we've learnt a lot over that period. We've made mistakes and we've made an opportunity built around very strongly our brand, our focus on our clients, and what we call today putting the client at the centre. But the historical nature of that position of trust and heritage that Perpetual has, for my time in this industry, but also having the pleasure of being the CEO, is built fundamentally on the care for clients, the care for each other, and that understanding of the needs and those needs and preferences of clients as they change across all three of our businesses. I'd like to think we're also one of the few truly independent wealth managers in the market. And across our three businesses, Perpetual Investment, Perpetual Private and Perpetual Corporate Trusts, we take that fiduciary heritage very, very seriously. Some might call us conservative from time to time, but we want to protect our clients first, grow them second, and make sure that we have this relentless and consistent focus on value and delivering that for them over time. I want to touch on a couple of moments today, step back a little bit first, but then get on to some issues that I hope will help you round out the conference. And when I step back for a moment, I think it's important to think about particularly some recent data from the Financial Services Council, which, as we know, represents financial services as the largest single contributor to GDP in the Australian economy. We are roughly 10% of GDP, and we are now larger than mining and construction. We contribute over 150 billion to the 1.7 trillion in that economy. And so if Australia is truly going to be a services economy, then we are at the heart, the forefront and the future of that. And it's important that our politicians and our community gets that sense of trust and ownership that we all have for it. Now, over the past 40 years, that growth of financial services has almost doubled, in fact. And the critical role that we will play in the future of the Australian economy is very secure. We employ over 400,000 people, 50% of whom are actually women. We rank 14th in the world in terms of GDP. However, financial services manages 2.8 trillion and is the fourth largest contestable pool of funds in the world. So we clearly punch above our weight globally. Much of that is through compulsory super, but I think that is changing. I think that's probably changed for good, and it's actually about our industry growing to a profession, what we stand for, and as we become a profession, how we actually provide proper needs and preferences to all of our clients and stakeholders, including the politicians and including the public service, and how those three positions between industry, politics and the public service, I think, have really lost their way somewhat. Now there's almost 5.5 million baby boomers and our 24 million Australians. That has only just begun to retire, as we all know. It's the fifth year. That proportion of the population aged 65 or over is going to increase from 1 in 7 to 1 in 4 by 2035. That is a significant change on the needs and preferences that we need to provide. The ageing population, of course, is not only going to have an impact on our role and the economy, but on society at large when you think of health, wealth, and independent care and how those three come together. And so the superannuation and financial services system is going to continue to change. In fact, Deloitte predicts that pension assets and super will reach 1.5 trillion in the next 15 years. And to put that in perspective, there's roughly that 2.3 in super today as a whole. Now, the implications for our clients are profound, and you've discussed many of them today. Retirees, of course, need to have now a clear need for income and asset protection, as well as intergenerational wealth transfer. I think that's something we don't talk a lot about in Australia when we think about advice. From our heritage at Perpetual as a trustee, of course, that's something close to our heart, but we are on the cusp for the first time, I think, in Australia's history of true intergenerational wealth transfer over the next decade. And that's going to mean not only the baby boomers, the wealthiest generation, but if I look out here and see Greg Kirk in the audience, the Generation X's are going to inherit even more. And what does that mean for advice? What does it mean for the services and how you manage the pre and post relationship between all of those families? Of course, that's something close to Perpetual's heart. Challenging us, though, is what, and I heard on the last panel, this lower return environment in the world that we're operating in have been, and in my view, will for some time. For the best part of the last 50 years, our returns across all asset classes, as we know, have been strong. Equities, fixed income, other asset classes have delivered consistent good performance, and our clients and we did well. However, we're now in this era, sustained era of unprecedented central bank intervention. Valuations, we know, are stretched. Traditionally, defensive assets will not provide the same capital protection as they may have, and we know returns will most certainly be historically lower, will be lower than they have historically. So for all of us as advisors and investment professionals, the challenge is going to be how you balance this difficult risk-return reward trade-off as you have in the past, but more unlike any other phase going forward. And how do you prudently avoid and allow your clients to move from accumulation to income with intergenerational wealth transfer? For advisors, it's going to continue to be imperative to manage expectations of these strong returns at a time when we've seen, particularly in the last 12 months, a strong equity market stag without underlying fundamental valuations there. We call it at Perpetual the much lower for much longer environment. Not just lower for longer, much lower for much longer. And how do we prepare our business and prepare our clients for that? I'd also add, though, on the good news, there's a 2016 cross-border flows report that Perpetual sponsors with the FSC that shows continued strong inflow of capital to Australia, particularly from Asia. And in fact, it's more than doubled in the last 5 years, and it's growing at by over 18% per year. Fixed income and Australian property are, in fact, the beneficiaries of the bulk of these flows. So as we know, Australia is a very attractive environment, both from the rule of law, the MIT environment, withholding tax, the quality of the assets that are here. Valuations are high, but for property and infrastructure, those capital flows are going to continue. So the consequence of that for our clients and portfolios is that traditional valuations are going to be high. Defensive assets that may have been well suited to retirement's needs will be valued even higher. And that's going to present a trade-off as well for investment managers. I do believe overall, though, that there's going to be more opportunities than there are risks. But the increasing competition for assets from global investors is only going to continue, and you should consider that. The lower return environment that I've just touched on is also, of course, putting pressure on asset managers' fees and their margins, as I'm sure you've been talking to the asset managers in the room today on. Clients are increasingly demanding more and more value for their money from asset managers. You might say that's no surprise. I don't think it is. I think what they're actually asking for is transparency and truth in delivering of that value, as clearly margins are more and more under pressure. And as a direct result, we've seen the rise of passive strategies. And passive FUM has doubled from 200 billion to 400 billion in the last decade. In fact, that's twice the rate of growth of active FUM in Australia. Now, of course, as you all know, Perpetual's an active value manager, and we haven't given up at all. I always believe, and still do, that there will be room and is room for both active and value. But moving more clients to passive only can only appear in the short term to increase or be an easy way to increase net returns. However, the more passively managed money that there is in the market, the more opportunities I believe there are for good active managers to not only survive but to thrive. And so client demand, coupled I should say, with the rapid technological changes, again MDAs are an example of that, are also going to drive the development of vastly different best practice or practice management tools and increasing sophisticated environment for advisors to have on their desktop. I think the arms race that's been there for platforms will continue, but there's new, smarter, bespoke strategies that I would find very interesting and I think would be very useful to harness for your clients. So how do you bring all this together? What does it mean for you running a practice and what does it mean for the asset management industry and advice profession? Well, I've used a few specific examples of the current issues, the macro trends and where it's leaving us in Australia today. But I think you should step back a little bit and think about the 4 key elements that are here on this slide that I believe are representing and driving client demand. Specialist expertise. You can't be a generalist, you must be a specialist. Greater control. Greater control comes with transparency and clearly the need for demonstrating, not just talking about, value for money. And now individually, each of these elements are important, of course, but ultimately none of them will be able to be accomplished individually or collectively if we or our clients therein don't have a view that they can trust us. If they don't have a view that they can trust what we do, how we do it, or what we say about the future. And if we can't put the client at the centre of every one of those conversations and each and every act of what we do and every decision that we make, then we know the consequences. Now, I want to talk to you a little bit about our experience at Perpetual and how we've dealt with this to bring it home. It may be a little bit different to your own because of the heritage and the size of our business, but Toby's asked me to dig in and actually now bring that to what have we been doing, particularly in Perpetual Private, and how we bring that home to our clients. So let me just touch on that a little bit. Obviously, we're really proud of the investment capability that sits both within the Perpetual Investments business, roughly 25 billion in Aussie equities, 10 billion in other credit and multi, but equally the 13 billion that sits in Perpetual Private, which is separately and individually run for our clients. And that's obviously been run over many decades. Having started our life 132 years ago by Edmund Barton, who became Australia's first Prime Minister, and the Fairfax family, fiduciary or client at the centre is at the heart of everything that Perpetual does. It's very ingrained in the fabric of our business. But our investment capabilities have changed dramatically over that time, particularly over the last 5 and certainly in the last 10 years, where we've encompassed investment research teams in Perpetual Private that manage portfolio construction, implemented portfolios, direct equities, and multi-manager, as well as alternates. Our client solutions on managed accounts, managed funds, model portfolios have been required to be built out from the traditional place that we were in running a CMA to actually create this comprehensive advice proposition. Part of our differentiation that I'll talk about in a moment is client segmentation, true high net worth individuals. Our 13 billion on average client balance is around 4.8 million, so it's very targeted. But ultimately, it's through our underlying investment philosophy that sits across all the 3 businesses that we have about client first, making sure the position of trust is never lost, making sure we protect our clients first and grow them second. Often that's from their children, but also making sure that we're value driven in everything that we do. Nothing's been perfect. If you want to look for perfection, don't be in business, I say. But over that 130 years, particularly the last decade, we've evolved our advice proposition in the true high net space to take account of that change, to whether it be tools, processes, but it's been constantly driven by the needs and preferences of our clients. And so for us, we've had a willingness to recognise scale, whether it's our own or others. That's a really important message I'd like to leave you with today. And we have therein a willingness to recognise partnerships. We can't do it all ourselves. We tried that, almost failed us. Now we've taken a model and a culture that believes in integrity, excellence and partnership. And partnership is all about us knowing what we can do really well sustainably over time, and partnering with others who can actually assist us to focus on what we do really well, but deliver an integrable and quality or excellent outcome for our clients. That comes from that deep understanding of your clients, not trying to do all things to all people. We have 6,500 clients, 4,500 of them in perpetual private have more than $1 million. And as I said, the average is 4.8 million. So that targeted segment strategy does help us give that and focus on the better understanding of needs and preferences of clients. So we knew that high net worths want direct equities. A house of active asset management in Aussie equities had to build direct equity portfolios for its high net worth clients. We went about that very deliberately about 8 years ago, and we continue to deliver model portfolios around direct equities. And in fact, about 60% of new client monies are in direct equities. And so we knew that they also then wanted or had an appetite for alternatives. So we built 2 alternative funds, an income and a growth fund. Each now have roughly in total about $1 billion together on them, only sold to our clients. So again, listening to their needs. I think finally, we've built a strong and durable governance structure over that. The strong investment process is independent. We use the quality lenses across perpetual investments and perpetual private, but after that, the teams are left to their own individual governance, and they have different client needs and preferences and different governance teams and processes. It's only executed by professionals, making sure that we have the highest bar of entry to the professionals that join our business. Only the highest, and only let the best in. And making sure that that investment is in them as well as in their process. And that, of course, independently is overseen by separate and independent investment governance committees, which is both rigorous and process driven. So as a business, you're probably asking, how do you balance all of that together to get a good advice outcome with a strong business outcome? We're all here to make sure that you have the sustainability in your own business to grow and prosper. That, for me, works hand in glove with clients. So perpetual private, one of the ways we've delivered these strong outcomes is through managed discretionary accounts. As you can see by this slide, we've given it a real focus and it's made a real impact, both for our clients and for our business. In 2014, we relaunched what was a long-standing, but maybe not very effective MDA account process. And since then, we've gone from having a very few number of clients, as I said, 6,500 true high net worth clients, to now having over 40% of our clients using various iterations of our different MDA structures. And over the last 3 years alone, MDA use amongst clients has increased 4-fold in the last 3 years. And the amount of FUM covered by MDA has increased 5-fold. So 5 times the growth in FUM, 4 times the growth in number of clients in the last 3 years. It's quite a different outcome for us and our clients. It's of course reduced for our clients their admin. It frees them from having to confirm every investment decision that we make. And those of you who deal with high net worths know that wanting to be involved is important, but having choice and making decisions is hard. So it's not necessarily, it's in fact harder in my experience across your segments and advice dealing with high net worths in a non-MDA structure. So it's freed them from having to be part of that investment decision that when we tested it, 99% of the time, they went with our recommendation anyway. It's also, of course, delivers them information on their portfolio in a far more timely manner. It gives best execution to them around the changes in their underlying portfolio, and it speeds up the overall end-to-end planning process and reduces that timing risk between when we may have made a decision, spoken to the client thought about it, come back to us. Stock could be in a very different position by that, particularly in today's markets. And now for our business, of course, it's helped us ensure that we deliver consistent outcomes for all of our clients. It's really important. Again, the strength of our brand is protect you first, grow you second. We stand for consistency and client centricity, so all of our clients are in the MDA structure get the same equal outcome, which also means we better get it right. But at the same time, it's reduced our risk to those clients. It's reduced that risk of investment performance leakage massively. It's improved our efficiency to a point that we no longer measure it, we just know it is there. And it's allowed our advisors, most importantly, if we stand for advice, to spend time with their clients, not on the investments in their portfolio, but understanding their needs, their preferences, knowing how to talk to them, listen to them, and explain things to them. Having said that, MDA structures, of course, bring with themselves individual responsibility that's even higher than the standard advice processes. And that requires then that high level of trust that I was mentioning earlier. There's 4 key elements of delivering a quality advice outcome and meeting client needs must come with trust. If you don't have that position of trust, you shouldn't be in the MDA structure because the bar is even higher. And so that trust is that we will always do the right thing first. And that, of course, we're going to be vigilant over their risks. Sometimes we all make mistakes. That's human error. But we must make sure that we deliver on what we promise or what we say we will do, of course. So bringing it together, I think the financial landscape is incredibly fast-paced, as we all know. You can't work in our industry unless you love change. It's continuing to evolve. It's not a fight for passive or active. In my mind, it's a fight for really understanding and establishing trust with clients. And that's where you will win. And there's a place for both active and passive. This pace of change, though, is increasing even faster every year. If I look back over what we planned for 5 years ago versus what we can plan for over the next 2 years, it's at least threefold. And of course, our clients in that environment want greater control. They want greater transparency. They want greater value for money. And all of that, importantly, leads to a greater trust in our profession. Thank you for the opportunity today.
Thanks very much, Jeff. Thank you.